Hi, I'm Jimmy. In this video, we're going to look at inflation. Specifically, with all the money that the US government is printing, how likely is it that inflation moves higher? And does it possibly hit the dreaded hyperinflation level? Okay, so I think the most logical place for us to start is with a very simple definition of inflation and hyperinflation. So, inflation can be looked at as the increase or decrease in the price of goods and services. Simple enough. So basically what's done is they take a basket of goods that the average household buys, and then they price it out every month or two, and those numbers are tracked, and then they price them out in different cities and they average them together, and they look at what is the average price for the entire basket, and does it move higher, does it move lower? Now some things aren't included in that basket. Things like stocks and bonds are not included, so if the stock market moves higher, doesn't matter to the average consumer, since really what they're looking for is day-to-day expenses. Now, we might ask, is inflation a good thing? Well, the short answer is no, of course inflation is not a good thing. But as we could imagine, well, there's a huge amount of possibilities when it comes to how much the price of something might change. So, this is a very simple scale of how we can look at inflation. On the left side, we have the annual percentage change of a basket of goods. Now, typically the government, the Federal Reserve or the Treasury, and most economists agree that the average target inflation rate should be 1, 2, or maybe 3%. Now, we might ask, why not target a 0% inflation rate? And one of the key reasons that this doesn't work is because inflation is not set by the government. Sure, it's influenced by the government, but it's not set by them. So in a free market, well, or in most developed nations, well, imagine telling the local grocery store that they cannot increase or decrease the price of bread or milk or clothing or whatever the goods are that they're selling. No matter what the supply or the demand market is, they have to keep prices exactly the same. That's the only way to get a 0% inflation rate. But because companies and businesses are allowed to increase or decrease their prices to be more competitive or to make a larger profit, well, we end up with some sort of inflation. So that's why ending up with a 0% inflation rate is very unlikely. Okay, so let's say we accept that. Why should the Fed target, let's say, 3%? Why not target something closer to zero? And that is because, yes, inflation is a bad thing. Nobody likes prices moving higher on them. But deflation is worse. And as we can see here, well, deflation is when the inflation rate goes negative. And history has proven that deflation can be a huge potential drag on an economy for a very long time. Now, economists have figured out that a low, stable inflation rate is much more logical than letting deflation happen, or certainly not letting hyperinflation happen. So what is hyperinflation? Well, hyperinflation is loosely defined as a super high inflation rate. Now, I've seen some definitions online, and I've even seen some comments people have left in different videos where they say hyperinflation is 50% inflation every month. And without a doubt, yes, that is absolutely hyperinflation. But in my mind, that is way too high of a bar. Are we suggesting that if it's 40% a month, that's not hyperinflation? So I think it's actually much more logical and a much lower bar, a much more reasonable bar to go with the definition set by the Financial Accounting Standards Board. And they're the people who make the rules for what accounting rules, generally accepted accounting principles, that companies have to use in their financial statements. Well, they define hyperinflation as cumulative inflation of more than 100% over a 3-year period. So if we assume compounding, well, that would mean 26%. Inflation each year for 3 years would qualify as hyperinflation. Now, the reason I think that this is an important distinction is because let's imagine that we're analyzing a company, and we see that that company is doing business in a country that has an inflation rate, let's say, of 30% a year over the past 3 years. So it's past to 26%. Well, we can't look at that and say it's not 50% a month, so it's not hyperinflation. It is hyperinflation, and because that qualifies as hyperinflation, well, that company has to follow a certain set of accounting rules to account for how their balance sheet will look, or how their ultimately how their income statement will look. So the financial statements get affected when they do business in a hyperinflationary economy. So having the proper definition for hyperinflation is important. Okay, now the real question is is the US economy heading towards hyperinflation? So there are a few factors that affect inflation. There's many factors, but some of them are things like output, unemployment. Unemployment is a very important one because, as we can imagine, it would be a bit tougher to have inflation when you have high unemployment. To put it simply, for a mass increase in prices, you really need wage growth. You need low unemployment. So I think that that's fairly logical. It's very difficult to increase the price of bread or milk if 20% of the population is underemployed or unemployed. So higher inflation is trickier with high unemployment like we have today. Then two other factors for us to consider, and this one's really on the forefront of everybody's mind, and that is the money supply and also the velocity of money. So the money supply is how much cash and liquid assets are in the economy. So all the stimulus that all the money that the government is printing up for stimulus, well, that's adding to the money supply. And this is one of the primary concerns right now for many people when they're talking about the fact that, or the possibility that inflation could come to the United States in big numbers, at a big level in the not too distant future. Now, if you're curious, I actually found some data on the US money supply, and we can clearly see that when COVID hit, well, we had a big jump in the broader money supply. So that's from the money being put into the system. And obviously, this is a bad thing. But when we pull up a chart of inflation, well, we can see that inflation hasn't really been a huge issue, even recently as more money has been printed. Now, one of the things I've seen talked about when it comes to the fact that why inflation isn't as high as it could be right now is the fact that a lot of the stimulus, some people are saying that a lot of the stimulus that the government is issuing out is going into investments, which are not counted in the inflation calculation. And this makes some sense. And to help us illustrate, well, another factor for us to consider is the velocity of money. So basically, the velocity of money is how many times a single dollar is used to buy goods and services over a specified period of time. So how many times is a single dollar used in a week, in a month, in a year, whatever the number is? So to give a crazy example, just to illustrate the point, let's imagine that the Federal Reserve or the Treasury or whoever called you today and they said that we're going to add some stimulus to the economy and we're going to give you $2 trillion in your checking account. Clearly, that's a ton of stimulus, $2 trillion. And then they call me up and they say, hey, Jimmy, we're going to give you $5,000. Well, I take that $5,000 and I say, cool, that's awesome. You know what I've wanted to go on vacation. I'm going to take my family on a cross-country tour across the United States. I live in New York, we're going to drive to California and back. Well, at every stop we buy food, maybe we buy souvenirs, we stay at hotels, go visit cool places, and we end up spending all $5,000. But you, on the other hand, you take the $2 trillion that they gave you and you decide you're going to leave that in your checking account. You're not going to do anything with it. For some crazy reason, you've decided you're not going to spend a dime of it. Well, the question is, how much inflation will the country see? Well, the $5,000 that I got, well, there will be some velocity of money. I use that at different locations on our vacation. Well, we don't know what the people that I spent it with. So we stopped at some place and we bought food. Do they then take it and do they go buy food themselves? Maybe they go buy clothes. If that's the case, that the velocity of money there will be greater than 1. But the $2 trillion you got, on the other hand, will not have any velocity of money. It will just stop and sit right there. Therefore, we won't see any inflation. Now, if you decided instead you're going to take that $2 trillion and you're going to buy stocks and bonds, well, we're still not going to see any inflation since stocks and bonds are not counted in the calculation of inflation. But you know what we will see? A stock market go sky high. It would be disproportionate to what's happening in the economy and what would be happening in the stock market. Some parallels to the current situation. Now, of course, that's an extreme example, but I hope we can see the point. The more money circulates through the system, the higher the impact will have on inflation. Now, it's also extreme in that, in this example, it went to one person. But if you gave that money to companies, hypothetically, and those companies went out and did stock buybacks, well, you end up in the exact same situation. How much of the trillions of dollars of money printed up just went into the stock market, driving prices needlessly high, but it doesn't really affect inflation. Now, I should also point out that some economists believe that the velocity of money simply doesn't matter. And that's because of the way it's calculated. So it's calculated by comparing GDP to the money supply. So when we see a big spike in the money supply, well, the velocity of money goes lower. And this is logical and may be true. But as far as I can tell, with unemployment at a relatively high level, which is likely to push inflation lower, and the government is printing tons and tons of money, which is likely to push inflation higher. Well, we know that a ton of money is going into the stock market and the bond market and investments in general. So if we just look at the prices, well, I think that it's very possible that this is the reason, the balancing effect of what's happening in the broader economy, that we haven't seen inflation on a large scale, at least not yet. Of course, it's possible that the government goes too far and prints up too much money, and then the velocity of money begins to pick up, unemployment begins to fall, and just like that, it is very possible that the government or the country is facing the real possibility of inflation moving significantly higher. Now, if things do shift around, well, I would expect for the Federal Reserve to cut back the money supply very, very quickly, which they can do fairly quickly. If we got anywhere near, let's say, double-digit inflation, 7, 8, 9%, I would expect for interest rates to start going up quickly, which would lower the velocity of money. I would expect for them to cut back their money supply, which would reduce the amount of money out there, and that would possibly help control the inflation rate if it got there. So looking out the next year or two, I don't see hyperinflation as a valid concern over the next couple of years. Beyond that, it's really tough to tell. So many things could happen between now and then. But over the next year or two, I don't think that is a real possibility at this point. Unless, of course, things change quickly, which is possible. I just think it's unlikely. Now, if you're curious how high the stock market is today, well, I recently did a video where I looked at how overvalued the stock market appears to be using things like price to earnings ratio, the Buffett indicator, the Shiller PE ratio, things along those lines. So if you're curious, perhaps that's a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.